We think that the spot price will strengthen as Q1 begins and buyers come back to work. Utilities clearly have been very quiet. The term volumes in the spot market, we don't have the final numbers yet, but estimates are around 110 million pounds procured, which sounds like a lot of material, but that is way below replacement rate contracting. If you take out the Chinese contracts that were signed this year, which were quite large, the amount of uranium purchased by the rest of the world looks quite low. And that's why I think we remain very constructive and bullish.
John, when we discuss the uranium market, we have to look at it as two separate markets between the spot market and also the term market. And according to Trade Tech, the term market price was up 14% in 2024, but the spot price was down 16%. Why did we see such a huge disparity in the prices of these two markets?
Yeah, it's a good place to start. Obviously, it was a frustrating year in 2024 for uranium pricing in the spot market. But let's start with term first, because that's obviously the much bigger of the two markets, the more important market that we watch obviously very closely. And the term market is where utilities are signing contracts for future delivery of uranium to cover their fuel needs. And last year we saw the term price go up every single month. And I think for 28 months in a row, we've had either flat or higher term pricing. So the trend is your friend, so to speak. The price has been going up steadily. And that's because we're seeing demand signals. And those demand signals are from reactors that are getting life extensions, reactors that are restarting, shuttered reactors being announced that we're going to restart, and then obviously all the reactors that places like China are building, et cetera. So that's creating a lot of future demand. And those signals are there and the price has gone up. What's also important to note is that the ceilings, which is one of the terms of these long-term contracts, which is the upper threshold of what a company will ultimately pay when they receive their deliveries in the future, that price keeps going up. If I think about where that ceiling price was, say 12 to 15 months ago, it was around $80 a pound. Now we're hearing those ceiling prices are in the range of 130 as high as $150. So the prices are definitely moving up. Now the spot market is much smaller, and the spot market is more, I would say, investor driven. It is more sentiment driven. And there we saw a big move in 2023 where the spot price was up 89%. And this year we've had a correction and the price ended the year at around $76. And that's disappointing because all of the news flow, I would say, has been incredibly positive. It's only strengthened in terms of the fundamentals longer term. But investor sentiment was soft, and it was very soft into the summer and then soft at the last couple of months of the year. I think it's soft for a few reasons. One, I think there's just been less investor interest. There's definitely been some distractions in the marketplace. Things like tech stocks and cryptocurrencies, I think, have taken a little bit of that investor attention away. I also think some of the investor attention has also shifted downstream to some of the nuclear utilities. So let's shift to the spot market. The spot market is obviously the much smaller of the two, and it is really being driven by financial intermediaries and investors as opposed to utilities. Utilities historically have purchased 5 to 15% of their fuel needs in the spot market. Sometimes producers come into the spot market as well to buy uranium, but it's the much smaller of the two markets, and so it's not as widely followed by the utilities, but it is still nonetheless a signal. And sometimes it sends, I would say, a leading signal to the market, which often will be a signal that the term price is moving up, which it has been doing the last few years. But last year, the spot market had a really big move, 2023, I should say, up 89%. And this year, in 2024, we've obviously had a bit of a pullback from 91 to 76. And, I've had a lot of institutional investors call me in the last few weeks saying, okay, what's going on? What signal is this sending us? And we think that one of the biggest reasons why the spot price has softened in the last couple of months is we've seen a lot of selling of material in a very thin market as we got close to year end. We suspect there are one or possibly 2 different funds that have liquidated their positions in the spot market in the last few months. That clearly has put some pressure on the price. The price seemed to have bottomed out just after Christmas at around $70 a pound. And in the last few days, we've rallied back up to 76 as some buyers have kind of reemerged and taken advantage of that dislocation. So it feels to us like it's a temporary dislocation. We think that the spot price will strengthen as Q1 begins and buyers come back to work. Utilities clearly have been very quiet. The term volumes in the spot market, we don't have the final numbers yet, but estimates are around 110 million pounds procured, which sounds like a lot of material, but that is way below replacement rate contracting. And once again, if you take out the Chinese contracts that were signed this year, which were quite large, the amount of uranium purchased by the rest of the world looks quite low. And that's why I think we remain very constructive and bullish, because all you're doing is you're kicking that demand down the road. It's all going to be eventually pent-up demand, which is going to, I think, support the uranium price.
And you mentioned 110 million pounds were contracted in 2024. How does that compare to 2023?
Yeah, so in 2023, the number was 160 million pounds. And that is considered by the industry to be at replacement rate contracting levels. But again, there was a very large one-time contract between the Ukrainians and Westinghouse and Cameco that was about 40 million pounds of that. So if you take that out as a non-recurring item, we would argue the industry has not been at replacement rate contracting for 2 years in a row, even though the uranium supply chain has become much more susceptible to disruption, even though we've had a lot of supply challenges with both brownfield and greenfield. And, you know, our position in the last few years has been that the spot price is going to be volatile in the short term, but is going to grind higher. And if you look at the average spot price in 2024, it was $86 for the year. The average spot price the year before was $61. So that's a pretty good move. So even though we didn't finish strong, the average price last year was meaningfully stronger in 2024 than 2023.
And you also mentioned that a couple of funds were selling in late 2024. Can you characterize the type of those funds? Were they hedge funds or?
It's hard to, it's hard to confirm, but I think it's pretty widely believed in the marketplace that the Kazakh-based ANU fund, which was set up a couple of years prior, was in the process of being liquidated in 2024. And we think that upwards of 2.3 million pounds may have been sold late in the year, and we think that had an impact on the price for sure.
So the Sprott Physical Uranium Trust, or SPOT, is now holding 66 million pounds?
Just over.
How many pounds were acquired in 2024?
Yeah, last year we purchased about 3 million pounds. I think we're at 66.2 million pounds right now.
I want to ask you about some of the uranium equities now. And once again, we saw a big disparity in terms of price movements. Cameco did pretty well. It was up 30% on the year, give or take. But many other names were down on the year. And where we saw the real moves were in the utility names. Constellation Energy, for example, was up over 100% on the year. Vistra, another big utility name in the US, was up over 300%. Do you think a lot of the hedge fund money has moved to these utilities?
Yeah, I think 12 months ago when the uranium price broke through $100 a pound, we clearly had a lot of, I think, transient hedge fund money that was chasing the trade. I think a lot of that money is gone. The hedge funds that are left in the fund, they've been in the fund, I think, for a number of years and are sticking to their thesis because they're going through the thesis and they're going through their models and they're saying, look, nothing's changed. If anything, everything keeps getting better. So if the price goes down, that is not a sell signal. So I think we've had some rotation for sure. Some of that money, I think, has gone into as I mentioned, the downstream companies who are going to benefit from this nuclear renaissance, that are benefiting from the Inflation Reduction Act. They're benefiting from all of these various big tech deals that are being signed between utilities and AI-related technology companies, which is something we never would have anticipated even 12 months ago. And I think it's a pretty exciting development in the field because it's going to bring a lot of capital, which is really important. I read that Microsoft has said they're going to spend $80 billion on their AI data centers in 2025 alone. It's mind-boggling. And that's everything from equipment to land, et cetera. And so if you can find the chips and the code and the people and the land and put these things together, you need the electricity. And that's what they're really focused on, is sourcing electricity with baseload power attributes, but also clean sources. And I think they, for a long time, focused on renewables, buying renewable energy credits and whatnot as offsets. But they finally came to the conclusion that they need reliable baseload power to match these AI data centers. And that's why they're signing these 20-year power purchase agreements with the likes of Constellation Energy at prices way above spot pricing, which tells you how important this electricity piece of the puzzle is for them. They are going to consume huge amounts of electricity. They are solving their own problem. I love this term, bring your own power. They're going to sign a lot more of these kind of behind the meter deals with local utilities, either with existing nuclear power stations like they've done with Constellation, or building the next generation of small modular reactors, which we've had a whole flurry of announcements in the last few months around that.
You were talking about big tech and their need for additional electricity to power these data centers. But the last nuclear reactor to be built in the US was Vogtle in the state of Georgia. It took over 10 years to construct. And I'm just wondering how realistic it is to think that these data centers are going to be using nuclear energy, especially in the short term.
Yeah, well, I think the problem is going to be solved on multiple fronts. You're going to see continued investment in renewable energy. You're going to see natural gas powered electricity plants helping to offset intermittency. And then finally, you're going to see nuclear energy, both large scale and small scale, providing that backbone of baseload power. And you're right, it is a big challenge for the industry because we largely forgot how to build these things for a long time. And we lost those supply chains and that knowledge base of workers. And that's why I think China has been so successful building nuclear power on time, on budget. Is they just build the same model over and over again. They have incredibly strong efficiencies of scale, and their supply chains are very resilient. And that's something that unfortunately the Western world is going to have to relearn, like we did in the 1970s and 80s. I think the exciting part about big tech is the cultural difference that they bring. They are accustomed to being highly innovative, highly disruptive, much like the small modular reactor companies are. And they're willing to be the ones that are going to finance these first-of-a-kind reactors, which inevitably are going to have some growing pains. Utilities, if you think about them culturally, they're about as polar opposite as you can get from a tech company in an AI race. So this is why I think these deals are so important, because they bring the much-needed risk capital, which is missing in this whole mix. And obviously there's some government money as well that is going to be available. The ADVANCE Act in the United States is providing almost $1 billion of funding. The Loan Program Office is obviously available to companies that are looking for additional capital. So I think it's great that government is finally starting to step up with some incentives and risk sharing, and big tech, given how deep their pockets are and how willing they are to win this AI race, I think is really important.
John, we can't have a discussion on uranium without talking about the country of Kazakhstan, or Kazatomprom, the world's largest producer of uranium. And Kazatomprom has been fraught with numerous issues in 2024, which has hampered their production. In addition, just recently, Cameco said they had to suspend production at their JV with Kazatomprom due to various issues. And I want to get your thoughts on what all of this means in terms of supply and ultimately uranium pricing.
Yeah, it's incredibly important. I think we watch Kazatomprom as a producer very closely because they are the world's largest producer. They are one of the lowest cost producers in the world. And why that's important is because with every commodity cycle, you have price and demand signals, and then you have supply responses. And right now, for the last 3 years or so, we've had very bright positive price and demand signals flashing. And so you would expect that in free markets, you would have a commensurate supply response. And that supply response is starting to come. It's obviously coming from a number of companies, but Kazatomprom is always looked at because of its huge resources of uranium and its ability to bring more to market. And what we have learned in the last year is that they have certain challenges in country, which will limit their ability to bring meaningful new production to market. And why that's important is because we think having, I think, that continued supply discipline, so to speak, is going to prolong the bull market in uranium. If the market is not flooded with material, the price should stay higher for longer. And that's why we focus so much on them. If you take them at their word, they clearly have supply chain issues related to sulfuric acid. Those issues that don't seem to be solvable in the next, let's say, 3 or 4 years. And between now and then, we might have very limited new production coming from country. The other, I think, important geopolitical factor is where is their production going, is mostly to China and to Russia. So if you look at the huge contracts they're signing with their neighbors, I think it's probably fair to assume that 3/4 of all their production is going to those two countries alone. So that doesn't leave a lot for the rest of the world. And everybody's been trying to diversify risks in terms of geopolitical risks and supply chain risks and whatnot. And the world needs, I think, new sources of uranium that are coming from, countries closer to their reactors in the West. So Canada, I think, is very well positioned given its huge reserves of uranium in the Athabasca Basin. But these reserves are going to take time to permit. And we know the environmental permitting process is very long. And then you have to build the mines, and that can take several years because of the remote nature of those locations and the complexities of mining in that specific geology. But we're very optimistic and hopeful that those mines will be built in this cycle because they need to be built. And that's when we're going to get, I think, meaningful new supply. But that's still, 5 or 6 years away or even longer. And I think that's why the uranium price, if you look at it on an average annual basis, it keeps going up from 2020 when it was essentially stuck because the market is seeing the signals and the price is responding.
And if you're a Western utility, what does that mean? If you're trying to acquire pounds, where are you going to go if you can't buy it from the world's largest uranium producer?
Yeah, obviously there's been a number of different geopolitical challenges and operational challenges around the world. We still don't have the situation in Niger solved. That was 4% of global production that's still stuck in the ground. France is obviously scrambling around trying to figure out where to source uranium from now. We've always argued that the uranium supply chain, because it is so concentrated in a few countries and a few companies, is just more vulnerable to disruption. And we've obviously had numerous disruptions since, I would say, the beginning of 2022 is when the supply chain started to become, I think, more unstable. Obviously, a lot of that was related to the invasion of Ukraine. We've obviously got through the sanctions last year in terms of them finally becoming law and Russia obviously retaliating with a set of their own. And that's a big wild card, I'd say, for 2025 is, will enriched uranium from Russia flow west again? And so far, it hasn't. And that could be a bit of a wake-up call to utilities in terms of something that is more pressing to them, because that enriched uranium is obviously a lot closer to end use as opposed to U3O8. You can have all the U3O8 you want in the world, but if you can't process it into end state fuel bundles, you're really stuck. And those services are what are stuck right now, that conversion service step and obviously that enrichment step.
And with all the elements that you just touched on, why haven't the U.S. utilities been more aggressive in acquiring pounds?
I wish I knew the answer. It's a bit of a head scratcher. For 2 years now, I thought they would be more aggressive. We've seen some of their European counterparts, I would say, be more proactive, more aggressive buying uranium under long-term contracts. But for some odd reason that I cannot explain, it seems as though that some U.S. utilities have been dragging their feet. It's not a one-size-fits-all. Some utilities, I think, have been proactive and are well covered for this foreseeable future. others less so. And I think that those are kind of the stress points in the system.
So we have a new administration in the U.S. and Chris Wright is going to be the Secretary of Energy. What are your thoughts?
Yeah, well, anytime you have a change in political party, there's a lot of, I think, review of how things are going to change, what will change under a new administration, what's in, what's out. And I think it's important to remind everybody that Republican administrations historically have been very pro-nuclear. It's been Democratic ones, ironically, that have not. The last Democratic administration was incredibly pro-nuclear. Most of the major legislation that's been passed in the last few years related to energy, all was very supportive of nuclear energy. So that, in our mind, isn't going to change. We think Trump is going to be very focused on energy dominance, and that is everything. It's really about additionality, meaning adding a lot of energy, whether it's oil and gas, whether it's nuclear. We think it's all about energy dominance. And the incoming Secretary of Energy obviously is from an oil and gas background, very well known. But what was interesting and caught our attention, he's also a board member of Oklo, which is the Sam Altman-led startup that is developing small modular reactors. And why that's great is because he obviously has been educated on the benefits of nuclear energy, small modular reactors, these next generation designs. So that's great in terms of getting up the learning curve. And I hope that he will and his administration will be just as supportive of nuclear energy as the last one was.
John, as we wrap up, Sprott produces a lot of resources and research on uranium and nuclear energy. If somebody wants to access that research, where can they go?
Yeah, well, I think we're probably the most prolific in terms of writing and talking about uranium, given I think we're the largest manager of the world with uranium-related investments. So we spend an enormous amount of time following the market and talking about it in all avenues. So I would encourage you to come to the website. We write a monthly report that's very insightful, gives a really good summation of what's going on in the market. We've got a lot of really interesting podcast guests from all avenues of the nuclear fuel supply chain and nuclear energy, and they're always entertaining. I learn something every time. So I would encourage your listeners to go to the website and have a look at our insights and blog section on the website.
John, thank you.
Great to be back, and all the best for 2025.